Hi everyone, my name is Yehuda Levy, bringing you another one of our series of Come Learn With Me. Today we're going to take a look at the article, How Pension Plans Evolved Out of the Great Financial Crisis. So let's take a look. Okay. Public pension funds were not spared from the carnage of the great financial crisis, as assets and funding statuses eroded between December 2007 and June 2009. From 2009 to 2013, there was a significant dip in the aggregate percentage of required contributions paid. When the economy recovered, statuses and other plan sponsors normalized their contribution levels. A recent webinar held by the National Institute on Retirement Security in conjunction with consulting firm Siegel and Lazard Assessed Management reviewed the report, examining the experience of public pension plans since the Great Recession, which examines how public retirement plans weathered the periods market and made subsequent changes to public pension funds to ensure their long-term sustainability. Most plans recovered their losses between 2011 and 2014, 3 to 6 years after the market bottom. Despite the recession and subsequent loss of value, plans continued to pay out over $1 trillion in benefits to subscribers during the period. Todd Torza, vice president at Siegel, says that since 2008, the modules and risk assessment strategies of public plans have evolved greatly. Torza said, funding status alone does not indicate health of a public pension. After all, one cannot see the underlying assumption used. A plan's funding status can be measured in many different ways, and the way we measure can change over time. Plans today are on a much stronger measurement of liability than they were 15 years ago, according to Torza. Adjustments on the assumption of the modules in mortality, the assumption rate of return, general population counts, and the assumed rate of inflation are a few of the assumptions modified which give greater clarity into pension health post GFC. The adjusted module assumptions made in the past 15 years see the public pension funds are more conservative in their actuarial bookkeeping than they were prior to the Great Recession. For many of the plans, we find that the assumption changes are what makes up a large portion of unfunded liabilities, he says. Typically, assumptions have a much larger impact than investment gains and losses on overall funding status, Torza says. In addition to adjusting assumptions in modules since 2009, plans have moved towards a shortening of amortization periods. Prior to 2009, over 70% of plans utilized a 30-year amortization schedule. These changes help to decrease unfunded liabilities, helping plans arrive at or approach full funding status. In 2008, before the GFC, the median assumed investment return was a bit above 8%, whereas today, the median investment assumption returns to 7%. According to Torza, plans have used the past 10 years to recovery and equity growth to introduce more conservative assumptions to the modules. Over the same period, innovations to plan actuarial accounting has been enacted. Plans performed positively in the era following the GFC, capturing alpha while weighing the risk of the overall portfolio. Ron Temple, director at Lazard Asset Management, says that pension plans have delivered for the stakeholders very well over the past decade, and this goes underappreciated altogether. Temple emphasizes that the recent performance of plans following through with assumed rates of returns and benefits being paid out has been due to great professional management in the sector. During dating back to the 1970s and 1980s, the the investing environment was vastly different. U.S. Treasury bonds yields were above 10%. Back then, we get an 8% annual return. Did not take much thinking outside of fixed income and public equities. Temple explains, until the TMT Tech Media Telecom bubble burst in 2000, there was no reason for public pension to allocate money into private equity or hedge funds. It was in this era where public plans began to change how they allocated their assets. Since the GFC plan allocations have shifted away from 80% of assets being invested in public equity and fixed income to only 70%, indicating that since the GFC, public funds have shifted towards alternatives, including private equity, real estate, hedge funds, cash, and commodities. Private equity is a levered playing play on equity market, with the trade-off being higher risk and higher return potential, but with less liquidity. Temple explained, in the past 30 years, there has been a greater shift to allocate to private equity, which is usually not accounted on a market to market basis, like public equities. Plans like private equity investments due to private equity holding values, while public equity value fluctuates. Graphs presented during the webinar show that total assets of US state and local pension plans have doubled since 2009. Temple commended on the success of professional management, saying, "We saw equities rally 113% from the lows in 2009. From 2009 to 2015, plans allocated away from public equities to other asset classes, moving their gains, seeing high and buying low, and by doing so, serving their stakeholders very well." All right. Hopefully you enjoyed this episode of Come Learn with me. If you like these reports, please make sure you like and subscribe. And if you want help with your business, please check out the link in the description.